Okay, good morning, everybody. As I see attendees starting to file in. Good morning and welcome, and thanks again for participating in day two of the Sidoti virtual microcap investor conference for January. This half hour, we welcome Onfolio Holdings and CEO Dom Wells, who will share the story about Onfolio, ticker ONFO. And as time allows toward the end of the program, we'll have a Q&A where we invite investors to pop their questions into the Q&A function at the bottom of your window. And in the meantime, Dom, thank you for joining us.
Yeah, thank you for having me. I'm looking forward to this. So I'm just going to jump straight into the presentation. And yeah, I'm pretty sure there will be time for Q&A at the end. It's not going to take the full 30 minutes to get through this. Okay, so for those of you who are not at all familiar with the company, thanks for giving us the chance to introduce ourselves. Kind of most interesting thing that's happened is Onfolio. We closed our IPO in August last year. Before that, we were founded in 2018, and what we do is we acquire already profitable online businesses and we actively manage them. So we're not making seed investments. We're not just buying businesses and hoping to figure out a way to monetize them. These are already profitable businesses that we can acquire at what we consider to be pretty attractive multiples. We operate in sectors with long-term growth opportunities. They have positive and stable cash flows, and they face minimal threats of technological or competitive obsolescence. We don't focus on a particular vertical. We are more interested in businesses where we think, okay, this is a good business that's going to be around for a long time. It's something that we know we can add value to, whether it's through experience, certain skill sets that the founder didn't have, and just general expertise all around. Since our IPO, this slide's actually slightly out of date because 2 days ago we announced a fourth acquisition. So we've completed 4 acquisitions since August, and I'll jump across to the next slide. But basically, we received 12.1 million in net proceeds from the IPO in August. We've deployed over 6 million of that on those 4 acquisitions, and we'll use the remaining proceeds to fund future acquisitions. We won't use the entire remaining 6.1 million. You know, there'll be some for working capital and some for making sure we have a strong cash reserve, but basically the majority will be used on additional acquisitions. So the target size is $1 to $5 million acquisition size. We usually pay no more than 4 times EBITDA for the acquisitions. So that's going to be a business making 250 to say 1.5 million in EBITDA. And in reality, 250K is actually a bit small. So really our target size is 500K and up. And you know, one of our core competencies is finding these profitable businesses where the sellers can't maximize their business. A lot of these target companies, they've been grown by a sole founder or maybe a group of founders who have, through their passion and their expertise in the space and their desire to build a business for themselves, they've built a solid business and they've grown it to a reasonable size, but maybe they don't have the skill sets to take it further. Maybe they're just strong at one thing like paid marketing or email marketing. Maybe they're good at sales, but they're bad at operations. And so a certain percentage of those founders realize, or they can just sell their business for what is for them really a life-changing amount of money. And so a lot of them take that option and sell their business. And we come in as a logical buyer, because when you're buying a business at no more than 4 times EBITDA, that's a pretty lucrative price to pay. And then in addition, where the founder was not necessarily able to grow their business because of some of the limitations I just talked about, we don't necessarily have those limitations. We know how to hire good CEOs to come in and replace the founder. We know how to plug any other gaps. Maybe they need a stronger paid marketing team or something like that. And so, yeah, that's why we're buying these businesses. And there's at any given time, there's hundreds of millions of dollars worth of opportunities out there. So we have no shortage of opportunities in how many acquisitions we can make. So yeah, once we've deployed the IPO proceeds, the idea is to then raise non-dilutive financing to capitalize on additional opportunities. So we're not looking to deploy additional equity at this time. And so the idea is, yeah, keep our entire business model is about, well, that's the next slide. Here we go. Okay. But yeah, our entire business model is basically grow through acquisitions. Yes, grow those acquisitions as well, but growth through acquisitions is going to be the kind of the largest way that we accrue value for the company. So a little bit about us, the management team. We have a highly qualified management team in place, approximately 70 years of combined experience. I would say we started out as business operators first, people who understood online business and have spent over 70 years in our combined experience growing and running and buying online businesses. And so we have a strong ability to evaluate potential acquisitions. We're pretty conservative when it comes to making an acquisition. In terms of the vast majority of businesses we look at, we disqualify. We're definitely not indiscriminately buying, whatever we can get our hands on. And I think a key thing is that the business plan we have allows for profits to be easily reinvested. So maybe we reinvest some of the profits back into growing the businesses, but we can also reinvest the profits into buying additional businesses. So we're not really buying businesses where there's huge capex requirements and a lot of inventory that needs purchasing and machines that need upgrading and so on. So what do we consider an ideal acquisition candidate? So as I've mentioned, we're kind of agnostic to a particular industry or a particular business model, but there's still many things we don't go for. So our ideal candidate is something which has a proven track record with, ideally with paid media. So it's not just relying on social media strategy or the founders' relationships and things like that. Obviously, we want something which has upwards growth trajectory in a growing industry or sector, a passionate, high value audience or customer base, attractive profit margins, cash flow with unleveraged marketing assets. So what we refer to there is basically, let's say it has a very large email list of customers or subscribers, but for whatever reason, they're not leveraging that. And then ideally, there's a community or an audience that is around the brand, because that is something very important in online business when you don't necessarily know what the next thing is going to be in terms of the strategies and the tactics which work with online business. But if you have a strong audience around you, you are much more able to adapt to those changing trends. So for example, let's say you have a marketing agency. The things you're doing for your clients today, maybe you're helping them with TikTok, you're helping them with LinkedIn, you're helping them with SEO and all of these things. And then you're doing certain tactics within those platforms as well. Now, 5-10 years from now, there's no way for us to know if those things are still viable. But if you have a strong company with a strong brand and a strong audience and following, then as the things that work today kind of become obsolete and new things become apparent and become popular, then you can essentially disrupt yourself. And so a big thing for us is when we're evaluating, is this business going to be around in 10 years? Does it have that ability? So as I mentioned, myself, the COO and the president all have kind of come from more of a digital marketing operations background rather than like a finance background, and then the CFO has more of the finance background. So this is a slide that's slightly out of date because it says there's only been 3 acquisitions, and as I mentioned 2 days ago we made another acquisition, so I'll talk through that one after I've talked through these ones. October 17th, we purchased SEO Butler, which is an SEO agency. SEO is basically search engine optimization. So the company helps other companies to rank at the top of Google. And then Proofread Anywhere is a online course business which teaches people how to build a career as a proofreader. And it's the leading brand in the space. And what we love about Proofread Anywhere is that it has large revenues and equally large profit margins. And so even though you might think a course about proofreading is maybe not that exciting, in terms of business metrics, it's actually a very good business, and it allows us to reinvest a lot of profit, a lot of cash flows back into growing the profit, and also into feeding other areas of the business and spending money towards future acquisitions. And then 10 days later, we acquired 2 WordPress plugins. It was actually one business which consisted of 2 WordPress plugins, and they're in the cybersecurity sector of WordPress. And we're actually quite bullish on WordPress plugins because they have a lot of recurring revenue. And yes, there's other softwares that come out now like Wix and Squarespace, but WordPress is actually still growing, and it's growing its customer base and its user base. And these plugins have strong recurring revenue, low churn, but we kind of have a little bit of an advantage because normally a SaaS, you might have to acquire it for something like 7 times revenue or 10 times profit. But WordPress plugins have all of the features and all of the things that software businesses have, but they don't come with those price tags. So Proofread Anywhere, we were able, the WordPress plugins, we were actually able to acquire them for less than 4 times profit. And then the 4th acquisition, which we announced 2 days ago, was contentelect.com. This one we acquired for $850,000, and it makes around $330,000 profit trailing 12 months. So that again is a very good multiple. So yeah, you may have seen our quarterly results. I'll put them up here, but I think an important thing to talk about with our financials is we've made these acquisitions, and we've basically acquired around 2.3 million in EBITDA since the IPO, and we've spent roughly half of our IPO funds. And so then the idea is to spend the rest of the IPO funds, which we see that as bringing us back to profitability. And then from there, we'll pursue the non-dilutive financing, which I talked about, and use that to acquire more businesses and keep scaling and getting those valuation arbitrage and the financial leverage as well. And so that's really our business model. Is we've got financial arbitrage, we've got valuation arbitrage. And then I think also worth considering is, we also have 6 million warrants outstanding from the IPO with a $5 strike price. So that's a potential $28 million also, which will come in as those warrants get exercised, which obviously where we're trading today is not going to happen immediately. But as that money starts to come in, that's more capital that we'll use to deploy and acquire more businesses and rinse and repeat and scale the flywheel from there. So yeah, that's it in a nutshell. If you have any questions, you can contact Alex and Greg from Gateway Investor Relations, or you can contact me. And yeah, I guess I'll open it up to questions now.
And again, thank you so much, Dom. We have plenty of time for Q&A, so investors that have questions are welcome to put them into the chat. Let me start with the first one that came in. How much revenue and EBITDA do you think the acquisitions completed and announced since your IPO will add to Onfolio over the next 12 months?
So the ones we've acquired so far, I touched upon a little bit already. So revenue would be around 4.5 million, 5 million that they would add, and then EBITDA around 2.3. And then for the remainder of the IPO funds, it's hard to say because different businesses have different revenues. Some the gap between revenue and profit is very high. Some it's very close. So yeah, it's hard to give a revenue number, but basically we're expecting to deploy at similar multiples of EBITDA.
If you could you call back up the slide, I think, before this one, because the next question pertains to how much cash does the company have on the balance sheet at present?
Yeah. Yeah, so obviously this is for end of Q3 because Q4 hasn't been published yet. But so we had about 11.7 million in cash at the end of Q3. We've made a few acquisitions since then, which have been announced publicly, so you can kind of deduct that amount from this number. In terms of shares, there's currently a float of around 3 million shares, but then fully diluted with the warrants and the restricted insider shares, it's around 12 million shares fully diluted.
Okay. How do you structure the acquisition payments? The mix of cash, we're talking earnouts, because I would imagine you want to see that there's the proof in the pudding at some point. So how do you go about compensating your targets?
Yeah, it really depends. And actually the structure is kind of one of the key things that, is very important to the success of a deal. And so it's usually a mixture of cash and earnout, but we'll pay all cash if the multiple's lower. So for example, with Content Elect, which was the business we just acquired, where it's profiting around 335,000 a year, off around I think it's around 700,000 or 800,000 revenue. And we basically said, I think the seller was asking for something like 1.3 million all in, and we said, based on where we think the business is and what we're comfortable paying and the trend and stuff, we can give you that 1.3, but then we're going to only give 600 up front, and the rest of it will be an earnout based on hitting certain revenue metrics and profit metrics, or we can just give you 850,000 all in, which was a win for us and a win for them. So they took that, and then Proofread Anywhere, we did around 50% upfront and 50% structured as a promissory note, and then the WordPress plugins has an earnout on it. And SEO Butler was all cash. So it's kind of a mix, but basically we'll use an earnout if we're concerned about, there's kind of two scenarios you use an earnout. One is if you have concerns about where the business is going to perform over the next period of time, and the earnout hedges against that. And the other is really when the seller believes the business is going to grow a certain amount and doesn't want to sell for the valuation that you've attributed to the business, but you don't want to pay them for this kind of so-called potential that they see. So the earnout there is like, well, if it does hit the growth that you say, then we'll pay you extra for it, but if it doesn't, then this is what we'll pay you.
So if we can go back a few steps, what is the due diligence process? How do you identify your targets? Is it a combination of being approached based on recognition of your business? Is it you and your management cohorts kind of prospect and find neat offerings that fit into what you have already? What is the thought process there?
Yeah, it's kind of everything really. When you're acquisition focused, you really need to make your entire deal flow process very professionalized. So we do direct outreach, and we have people we hire who just do direct outreach. And with direct outreach, you can't really use a kind of wide net where you just kind of spam the internet and hope for the best. You have to identify certain verticals. And so we might say, okay, right now we like WordPress plugins, go and see what's available, or we like agencies in the B2B marketing space and go off that way. But then we also get a lot of inbound, which has obviously increased since we went public because of the visibility. We now have investment banks also bringing us deals. I go on a lot of podcasts. The other management teams go on a lot of podcasts. That actually is a surprisingly strong source of deal flow. And then there's all the actual places where businesses are bought and sold, marketplaces, brokers, and a lot of the brokers will give us kind of first look at a deal before it goes on the market. Some brokers don't work that way, but some do, because they know that we have a reputation for being fair and I don't want to say fast, but a reasonable speed in making decisions, and so we have a good relationship with those people as well. So yeah, kind of basically everything inbound, outbound, and casting a wide net.
Great. The question from the audience is, are you looking to invest in and scale the businesses you acquire, or just roll up the businesses you can acquire for attractive multiples and run them for their cash flow?
Yeah, it's kind of both. So if you don't invest and scale a business, eventually it's going to die. And then you've kind of got this race against time where, well, what if it dies in 3 years and we've paid a 4 times multiple? Like, you can't just cash flow it and hope for the best. But at the same time, it doesn't necessarily make sense to us to deploy a lot of risk capital trying to scale a business. So when we have our businesses, and even when we're doing the due diligence before we acquire them, there's pro formas, kind of basically discounted cash flow spreadsheets where we think, okay, how much can we grow this business? What cash outlay is it going to require to grow it? How confident are we that that's going to work? And if we feel confident and we're thinking that cash is going to have a good ROI, then we'll do it. But if we think, yeah, we could double this business over the next 2 years, but it's going to require a huge cash outlay, and we're not really that confident in whether or not it will work, then there's other things we can do with that cash, such as growing a different business or acquiring a new one. So it's really about, like, yeah, we want to grow them and we want to buy businesses that we think we can grow without that scenario. But we don't have to grow a business if it doesn't make sense to grow it.
So once you have the properties in your hands, it's a decentralized management approach. I mean, do you is the idea to lend certain services that you or certain functions that you perform for properties A and B, and then when you add in property C, you can kind of cross-pollinate those? Or am I looking at it the wrong way? I'm kind of envisioning that you have somebody who has a great idea or a great product, just needs the help, and maybe is looking to sell to you. Once it's in the fold, like, how do you go about managing each of those properties?
Yeah, this is something that's evolved over the last, say, 3 or 4 years as we've run businesses certain ways and realized what works and what doesn't work. Right now, we're heading in a much more decentralized direction. Each business will have its own CEO. And where there's synergies and overlaps and abilities for them to cooperate together, we'll encourage that and facilitate that, but it's all optional from the CEO. And the reason for that is really the key way of growing a business is giving the CEO autonomy and this kind of entrepreneurial ownership of the business. And if we kind of say, right, you need to work with this person and this is going to happen, maybe you can achieve some synergies, but they're far, the growth you get from just empowering CEOs to do their own thing far outweighs any benefits of synergies. But at the same time, everyone's working for the same company, everybody, well, the same parent company, everybody is incentivized to grow. They'll benefit as Onfolio grows. So a lot of people do end up knowledge sharing and partnering up and working together because they trust each other and so on. And so it's optional. But then there are some centralized services like the back end admin, HR, legal, compliance, all of those things that there's no reason why each business needs to hire its own HR person and its own in-house counsel and stuff like that.
You made a comment earlier about the IPO. is being public primarily an advantage in terms of being able to attract acquisition candidates versus a competitor of yours who is not public? Is that sort of the mindset there?
Yeah, it was a big motivation for us. It was one of the big reasons why we went public, and the same for actually talent attraction as well, hiring the best people. The prestige levels have gone up significantly since going public, even though we're still a small micro cap company. The visibility has increased as well, so we're definitely a more preferential buyer because we're public, but also just a lot more people know about us. So it's increased the deal flow, as well as kind of put us at the top of the pecking order, especially in the space that we're playing, where we're buying businesses where they're kind of too large for an individual to buy, too small for private equity to be interested in. And so being one of the more well-funded and better reputation buyers in the space is definitely an advantage, and that is accelerated when you're public versus private.
And for context, earlier, I think you cited a figure maybe 4 times EBITDA for what you're able to, or for some recent deal acquisitions that you made. Is that kind of consistent? Is that like a going rate at this point? Do you feel that you're, getting a bargain, so to speak? I mean, or because there's such a vast opportunity to make acquisitions based on the size of companies you're picking up, does that just enhance your selectivity? If you could talk about, multiples, maybe in the context of what others in the market are paying.
Yeah, certainly in this size, I think if anything, multiples have gone down since late 2021, when pretty much everything was in a bubble, and then that's slowly gone down. So multiples were going up, and then they kind of leveled out, and they've gone down a little bit. I wouldn't say we've been getting bargains. I'd be just saying we've been paying market prices. But what's interesting is we see the opportunity to scale is not saying, okay, we've got 10 $5 million businesses, now let's go out and get some $20 million ones and some 30 million, because doing that we will then end up having to pay higher multiples. For us, the opportunity is getting hundreds of $5 million businesses, and that's again why we have to run them in a decentralized way, because it would be a bit of a headache trying to run them in a centralized way. So when the market turns around and the world becomes a lot more bullish again, I imagine multiples will start to creep up again. But if they go too high, then they kind of shoot themselves in the foot, because it reduces the buyer pool. Because if you're having to pay 6 or 7 times for these businesses, the ROI is not really there to justify it. So I think there is a ceiling on how high some of these multiples can go anyway.
Gotcha. So it sounds like sort of an advantageous position, which maybe feeds into the next and what may be the last question we have time for. And is Onfolio comfortable with current liquidity, or do you think you'll need to raise additional capital in the next year or two?
Yeah, that's a good question. Yeah, we're comfortable with the current liquidity. I think based on our current burn, if we didn't make any additional acquisitions, then our cash, we're losing cash, and we would probably run out of cash in about 2 years. But the amount of cash we have is enough to get us to profitability and have cash left over, so that we're comfortable there. And then a profitable company will have access to additional funds anyway to then increase. So we're comfortable.
Great. And with that, I know you have one-on-ones coming up, so I think this is a good point to conclude the presentation. Are there any final thoughts you'd like to share before we wrap up? No, I think I've kind of outlined our model pretty well, and the questions that have come in have been great. So thank you everybody for the questions, and I just hope everyone has a good rest of their conference, and looking forward to it. CEO Dom Wells of Onfolio Holdings, thank you so much for joining us and participating in our event. That will conclude the presentation. If anyone has questions to pass along to the company, you obviously have contact info here, or you could contact the Sidoti sales rep and we can forward them along. That said, everybody have a great day.
Yeah, thank you.